find your way back home.
Hello everyone, welcome back to the Eat Sleep Profit YouTube channel. Today what we're going to be working on and what we're going to be going over is patterns, finding entries and exits, and kind of really how my strategies entail. So a lot of people have been asking me about this and wanting me to, I guess, reveal some secret or whatever like that. So just first off, I mean, there's really no secrets in trading. I mean, a lot of stuff has to be replicable in a sense, and I don't really see there's no secrets to my strategy, especially how I trade. A lot of things go into it. It may seem hard at first because there's a lot of minutiae details that you have to start to get down. So everything I'm going to go over today is going to be something that you can look at, you can study, you can go over. But in turn, that may not just be the only thing that you need to be profitable. A lot of small minutiae details that I have to get into, especially later on, that's going to really help you from especially making very, very good decisions, taking your entries and exits, and being profitable in the long expanse. And that's kind of what my students do. But giving you guys a good background, this was what I want to do today. So going over my strategy and how everything is entailed, what I'd like to look for, especially to trade stocks, is going to be patterns. So I'm a pattern-based trader rather than more like, let's say, like the momentum side, where just any spike that happens, I'm looking to take a trade on that. Really with me, I like to take trades on stocks that set up a certain pattern or a certain sequence in price action, and from there I have some form of outcome that I'm looking for, especially if you, for example, ascending triangles or flag patterns or channel breakouts, things like that. You know, a certain sequence has to happen, and once that fully is finished, in a sense, from there you are going to be looking for like a breakout or a spike towards the topward side, and that's really what I'm going to be looking to take profit from. So it's kind of easy to, especially on a chart like this, to see, let's say for example, an ascending triangle develop on the stock here. It's pretty cut and dry. So a lot of times, especially like looking at charts like this, it's easy to see those patterns set up than they are in the real time. One thing about it is, in the real time, the main thing you have to do is you have to wait, rather than seeing like a fully developed chart like this. You're gonna have to wait for that spike to happen, those pullbacks, those higher lows, and for that breakout, especially to set up and try to get in as close as possible to that breakout point. That's easier said than done, and kind of those minutiae details get into play. But going over the patterns that I like to look for the most, especially my go-to patterns day in and day out, first off is going to be ascending triangles. So ascending triangles and IPHB patterns, as I call them, which stand for initial spike, pullback, higher lows, and breakout. So it's kind of like the patterns that I like to look for on the day in, day out basis, usually within like the first hour for 2 hours of trading. So usually that happens with an initial spike in trading price. That's usually going to be why I like to look for stocks that are above 15% in gains. If you look at my old scanner videos, that's all I used to talk about, is look for stocks that have spiked on the day, because usually they can spike again, rather than stocks that haven't spiked at all. So usually I'm going to be looking for some initial spike in trading price. From there, the stocks are going to pull back. When they pull back, whenever stocks gain on the day, especially gaining in price, people are going to be making profit, and in turn people want to take that profit. So that's going to cause the stock to pull back on the day most of the time. From there, after those pullbacks happen, you want to see the stock progressively set these larger levels of support, especially as it trends with a static level of resistance. So usually that level of resistance is going to be a price level all the way across. You're going to be able to see a building level of support with this stock, and from there you're going to be looking for this stock to bottleneck itself and look to break out above that level of resistance. And you're trying to get into an entry as close to that breakout point as possible and sell to some arbitrary sell point. Either it can be a percentage target, a profit target, or you can hold it as long as possible until it looks to pull back. I mean, there's multiple ways to sell that really work the right way, depending on really what your goals in trading are. But there's really only one way I really look to buy stocks, which is going to be as close to the breakout point as possible. The only difference between this pattern and if you was to look at, for example, something like a channel breakout, is channel breakouts don't have that progressively growing support level. So they're just going to bounce between a static level of resistance and a static level of support until they really choose to break out. And from there, that's really when you're going to be looking to play it. The main thing about channel breakouts since they're going to be already running a fair amount of distance from that nearest level of support to that resistance level, they sometimes tire themselves out before they actually break out. And once they fully break out, they usually don't run very, very far. So the main fix with that I've seen is just aiming for lower percentage targets at the end of the day. But all in all, those are really going to be like the two patterns that I really like to look for. Now you have to see the patterns in the price action. So I like to break things down into sequences like an initial spike, a pullback, a set of higher lows, and then a breakout. So first off, what you're going to be looking for is initial spike in price. So the initial spike in price is where a lot of people get it wrong. A lot of people use the initial spike in price as an entry point rather than it being, for example, the beginning of a pattern. So if you was just to play, let's say this stock, just looking to play the initial spike and you just want to buy into it and look to sell for a higher price, depending on where you buy and sell, there's no direct knowing of where's like a set level of entry and a set level of exit. So if you see with for example, like a pattern that fully sets up, you have some good notion of where your entry should be, and exits usually, if you're aiming for like a 10% target, you kind of have a good notion where your exit is going to be. Now, whenever you're playing initial spikes as they set up, it's very, very hard to know where that entry point or exit point is. I don't even think it really exists at all. It just really depends on where you buy, and hopefully you can sell for a higher price. So for example, if I was to buy into the stock at 0.65 and look to sell at, let's say, 0.73, that would have been a successful trade in all, and that would have netted me, let's say, 11% or so. So there's nothing that told me to buy at 0.65. I just bought into the stock because I saw it was spiking on the day, and I sold at 0.73 because it looks like a target that to me can be filled in the short term. I didn't want to aim too high and risk the stock pulling back and not fulfilling my targets. So there's really not a lot of strategy behind that. It's pretty much a lot of it's maybe 75% luck in a sense, maybe 25% skill. Now, for example, if you waited a little bit longer, if you wanted to buy into the stock at 0.69 and look to sell at 0.80, for example, so a target like this, you'll see that in the short term, the stock would pull back. It went to a high of 0.74, then it pulled back all the way down to 0.66. So in the short term, you would have took a loss on this trade, especially if you would have put a stop loss at a very, very close level. Now, if you see in the after spike, or for example, that stock fully breaking out later on, it easily surpasses 0.80 and goes to a high of the day of 0.94. So in turn, a lot of times what I saw when I first started trading, especially like 3 years ago, what I saw is I would pick the right stock, especially on the scanner. I'm finding the right place to go after. It's just I'm timing my entries wrong. So I'm not waiting for patterns to set up. I'm just buying them at any time. Hopefully I can sell them for a higher price. A lot of times you'll see is if you just wait 20 to 30 minutes, you'll see that stock easily meets and surpasses your original sell target, and sometimes goes even twice as high or 3 times as high. So the main thing about it is look for the setup rather than just looking for a quick entry and exit and trying to scalp the stock, because either you're going to scalp it and not make as much profit as you can, or you're going to aim too high and you're going to go bust. So that's really what I saw myself doing, especially early on. Now, whenever you use this initial spike as the beginning of a pattern, that's going to be those 15% in gains or more that you're usually going to see on the scanner before you set those on a watch list and look to watch those plays during the day. So by the time this stock is on the scanner, for example, this stock may be up, for example, this spike here was up 32% on the day, and by this time the stock fully spiked out, it's already setting multiple 200, 300,000 volume candles during that time. So it may have a congregate of maybe 2 million volume, and it's up 30% on the day. So at that point, I kind of know that the stock is watch list material. So by the time I'm going to be watching the stock is going to be probably at that high of the day point. Now from here, the second part of the pattern that has to set up after the initial spike is going to be the pullback. So the pullback on these stocks here, a lot of people get scared of pullbacks. Pullbacks are going to be inevitable with any type of spike that happens. I mean, as profit is being made, people are going to be looking to take that profit because it's not guaranteed. So from here, what you're going to see is stocks are going to look to pull back. Two things that are going to be important on pullbacks is the pullback is going to show you where that level of resistance is. It shows you where the buyers are drying up and pretty much the sellers become stronger, and the sellers take over and they kick the price back down, pretty much as people are looking to take their profit off the table. So usually at this price level here that happens when the stock fully apexes and it pulls back, that price level is going to be your set level of resistance that I usually draw all the way across. Resistance levels, to me, I like to look at them as price levels. So those are just going to be static levels that you draw across these charts. The second thing on pullbacks is you don't want the pullbacks to be no more than halfway down the initial spike. So if the stock spikes up 20%, you don't want that pullback to be no more than 10%, or if the stock spikes up 30%, no more than 15%. So usually a third of the initial spike is going to be around ideal, but no more than half. The main reason for that is you don't want the stocks to pull back so far, because if the stock pulls back very, very harshly, it kind of destroys a lot of ground that stock has gained, especially during the day. So especially every single time the stock pulls back, it kind of destroys a lot of its price action that it has developed, that doesn't give me a lot of confidence in the trade to hold it and to look to get into that trade, just because if the stock pulls back again, it's going to completely go right back down to where it was before. So that's really what I look for on the pullbacks themselves. Now, after those pullbacks have developed, you're going to either look for two different things. Either you're going to look for the higher low setup, which is what you see on these support levels as they develop. Support level is just going to be whenever a stock pulls back and it bounces off of that pullback level. So where the buyers start to kick in back again. So you can see here, they progressively get higher from 0.67 up to 0.69, and then again up to around 0.72. So you can see they're progressively getting higher and higher over time. So that means that the higher low setup is happening. Now, if these levels of support stayed static, let's say, for example, this 0.67 stays static all the way across, then it'll be more of a channel breakout, which is going to be something that you don't aim as high towards the topward side because of reasons we explained earlier. So from here, whenever I'm looking at a setup like this, once I have the initial spike, the pullback, and then the higher lows, that's really going to be indicating that the ascending triangle is setting up. And then you're going to be pretty much at the point where you're going to be looking for your entries. Now, getting into entries. So getting into entries, there's going to be trade-offs on both sides whenever you're looking to enter into a breakout pattern. So it's going to be very, very hard to really say, okay, enter at the breakout point. Because if you see at 0.74, let's say that price here around 0.74, if I was to look to enter at 0.74, let's say, for example, early on, I would have entered somewhere around here just for the stock to pull back and go back to a level of support. So I would actually be at a loss at that point. So just buying at the breakout point isn't going to be the best way. You can kind of work around that whenever you look at the level 2 and you see at those levels of resistance, you see heavy stacking sellers versus a very, very light bidders. Then you can kind of tell that the stock is going to pull back, but now a lot of times it can be very, very shady at that point. So what I'd like to talk about is on the entry side, the trade-offs. So whenever you're looking to buy into a breakout pattern, there's going to be two different sides to the story that I'm looking for. So what I mean by that is either you're going to be buying below the breakout point or you're going to be buying above the breakout point. There's its own pros and cons to each side. So the pros to buying below the breakout point. The pros to that means you get to buy into this trade at a cheaper price. So a cheaper price for your shares is always going to mean that you enter into the trade at a cheaper price, which means sometimes you can buy more shares to load up on, and in turn you can have a nice size position set up. Now the cons to that, the cons to entering into a breakout before that breakout point before the breakout has happened or under that breakout point is the stock still hasn't technically broken out yet. So the confirmation isn't there. So in turn, the stock still is setting up. So the rate of success is a little bit lower than actually buying the stock above the breakout point. So it sounds very, very counterintuitive. But in turn, if you think about it, if the stock has broken out, if it has set the new high of the day, people are going to see that, and especially they're going to be more willing to jump onto a trade rather than the stock that's still setting up. That's why usually within the setups, you can see down here, the volume stays relatively low, but once it breaks out, the volume shoots through the roof. That's just pretty much the logic behind a lot of traders here. So from here, if you was to buy above the breakout point, you would enter into the trade at a higher price. So you're entering into the trade maybe 5 or 10 cents above the breakout point, but in turn a lot of times you'll see a higher success rate with taking trades because the stock has broken out, which has confirmed the breakout within itself. As well, usually the volume is going to be at its highest point during that breakout, which in turn a lot of times can make those stocks run very, very quickly. So there's going to be trade-offs on both sides. One thing that I've seen is really my happy medium for that is looking to get into the stocks right as they break out. So kind of that middle point, not getting into the stock right as it's setting up. So I'm going to be buying the stock above the breakout point, but very, very close to especially that breakout point in itself. I try to see as close as possible that I can get into that breakout point. All stocks aren't going to react the same way. Some stocks will break out very, very quickly. Some stocks will break out slowly. It really kind of depends. Some stocks will move so fast that by the time you're looking to set your entries in, it may be too late. So there's ways around that. There's ways to get very, very quick entries in there, especially with Thinkorswim. You can use especially use hotkeys, or sometimes you can just use very, very simple things like you can just right click and hit buy, for example, and you can set an order that quickly. Especially with the active trader, you just pre-specify your shares and things like that. There's ways to enter and exit very, very quick. That's what I usually tell my students is I really should show them all the ways to enter and exit very, very quickly. But from there, just setting limit orders and trying to get into that price right as the stock breaks out is really going to be key for me. Now, one thing, whenever you're talking about entries as well, entries and stop losses have to really be combined. So what I mean by that is right after you enter into a trade, or even if you're looking to enter, you always have to have some form of loss scenario. Because let's say, for example, if you're 75 to 80% correct, 75 to 80% of the time, you're going to be setting your sell target and it's going to fill. Now, for the other 20 to 25% of the time that you lose, you have to have a strategy to lose. This is where a lot of people make mistakes and where they actually have a profitable strategy, but whenever they take losses, it completely eliminates a lot of profit that they've made. So you have to be very, very adamant on having a strategy to lose. And really with me, my strategy to lose is I like to set my stop losses at the nearest level of support. So this kind of helps to alleviate a lot of big downward swings that may happen. So if we look at the nearest level of support on this trade as the stock is setting up higher lows, these lows are going to be support levels. So the common notion, what a lot of people use is, okay, if the stock breaks out from a level of resistance becomes support. Now that is true in some certain scenarios, but a lot of times if you use that for breakouts, it's not going to be as solidified because that support level is so new. I'd rather use a support level that was tested and it holds true, which is going to be right below that breakout point. So this nearest level of support. So let's say for example, if I got an entry at 0.75, if I got an entry at 0.75 and my nearest level of support down here is 0.72, you can see I'm negative 4%. So my worst case scenario on the loss side will be 4% in loss. Now, what I like to say is really with my rules of stop losses is I want to have a maximum of 5% all the way around. But if I can use the nearest level of support, which is going to be a closer level sometimes, I'll use the nearest level of support. But maximum, I want to lose 5%. The main reason for that is usually I aim for 10% on the top side. When we aim for 10% on the top side, if you aim for 5% loss, it's a 2-to-1 ratio. So if let's say, for example, Monday you make 10%, if Tuesday you take a loss, you only take a 5% loss, which means you're still 5% up on the week. And if Wednesday you take another 5% loss, you're actually going to be at a 0 point. So you're actually still aren't going to be negative. You haven't really lost any money during the week. So it kind of gives you time to really see what you're doing wrong and to fix that before you really start to take losses. It's just a smarter way to do it. Now, the main reason I sometimes use that 5% universal stop loss is because if you're playing channel breakouts like this, by the time those stocks break out, they'll be so far away from the nearest level of support that you have to use like a stop loss in between that rather than using the nearest level of support as a stop loss. So that's kind of a lot of times how that happens. But stop loss wise, I just want to put it at the nearest level of support, or I want to put it at a 5% stop loss level. Now, after your entries and stop losses are placed, then you're going to be looking for exits. So on the exit side, the way that I look to exit, plain and simple, is looking for a percentage target. So a lot of people either look for a profit price per share target, or they look for an overall profit target. That is very, very misleading with a lot of different price ranges. Let's say, for example, I wanted to make $500 per trade. Now, if I'm trading with a $1,000 account, I'll have to make 50% on the trade. Now, if I'm trading with a $10,000 account, I only have to make 5% on that trade. So you can see with the amount that you're trading with will fluctuate and will determine how quickly your profit targets will be made. So the best thing to use is a percentage target, like a 10% target. So if I have a entry point of 0.75, all you have to do is aim up 10%. And you can see where your exit point is going to be. So around 0.82 is really where I'm going to be looking to exit. So at this price here, I'll look to set my sell target. I'll right click, hit sell, and automatically set a sell target onto the price point as it sits, and it'll wait to be executed. Usually it's going to be a limit order. So with limit orders have to be at the exact price or above on the sell side, or if you're looking to buy, it has to be at the exact price or below before it is filled. That's really how limit orders go. But plain and simple, to have a strategy to enter next and to, especially to trade these stocks and patterns, this is exactly how I do that. Now, you can be a little bit more finessing with how you trade, especially little small tips that I always like to tell people is, for example, if you buy into a breakout and the stock really starts to shoot up very, very quickly, the volume starts to kick in, and in turn the stock starts to run very, very quickly, all you really have to do is something as simple as move your stop loss from the nearest level of support to your entry price, and it pretty much means you're not going to lose any money on the trade. So you kind of have a free opportunity to trade in a sense. Now, there will be slippage. For example, if you enter at 0.75 and you exit at 0.74, 0.99. There will be some slippage here and there, and then with commissions too. So it's not going to be like your account was $1,000. Let's say, for example, as you start, like $1,000 as you enter, and if you take this trade here and you don't make any money off of that, it's going to end at $1,000. Usually going to take that $14 of commission round trip. But other than that, that's really not a loss. Commission is a part of the game. But from there, just small tips like that helps a lot. So in turn, I just hope that you guys learned something today. A lot of people always ask me, like, how do I set up my patterns? What do I look for, especially in the mornings? And this is exactly how I do it. Now, things will get a little bit more detailed. That's what I like to do, especially with my students. And whenever we work one-on-one, we go over the minute details like this of just every single part, because especially talking about initial spikes and what to look for can be a whole hour, or just talking about exit strategies and things can be a whole hour. I just want to give you guys a good general rough overview of really exactly how I like to set up my stock. So hope you guys learned something today. If you guys have any questions, just email me, eatsleepprofit@gmail.com. Especially you can DM me on Instagram and things like that. It's no problem at all. So just know any questions, just shoot me over there. Hope you guys enjoy it. Peace.